Greetings, this is Dr. Jeffrey Scott, and this is my weekend market update for Sunday, March 19th, 2023. I titled today, Will Bad Breath Lead to Next Leg Down? Frankly, we might already be started with that. My email address is hgsidoc@gmail.com. If you like these videos, please subscribe, hit the alarm button in YouTube adjacent to the video so you're reminded or notified when I post these, and hit the up thumb. Frankly, if you don't like it, hit the down thumb. I think the more people that hit them, the more likely eBay puts this up on people's feeds. As always, I really have nothing to sell you. I'm going to talk about the market. I'm going to remind you of a couple of upcoming meetings, and then I'll take a look within wealth charts at some of the stocks that I might be looking at. Just for spoiler alert, I'm not going to have a lot of stocks that I like. And if somebody does have a lot of stocks that they like, probably outside of semis, I'd like to know what they are, because this is a difficult market to say the least. Disclaimer, this is for educational purposes only. Anything I talk about should be taken as education and not investment advice. I am a doctor, not a broker. I am independent. I've paid for all the tools I use. Trading involves risk, and you are solely responsible for any investment decisions you make. First, the Wealth Charts Wealth 365 event is coming up soon. It will be in April, and would love to have you there. And you'll find it's a great meeting. If you don't have wealth charts, it's one of the better times during the year to buy it. Lots of folks will have things that they're offering at a deep discount during the meeting. And Rob Hoffman just puts everything he has into making sure it's a good meeting. Again, love to have you. I'll have the link beneath the video in the remarks section of YouTube. And I really appreciate if you use my link. I don't get any financial consideration, but Rob is very nice to allow somebody who doesn't have their own website and keep a huge mailing list, me, to participate. And I like to try and get some people to come into my link to show them that at least I can bring some people. The other thing to tell you about is, if you like these videos, I do something like this most days. Now, to be honest, I probably record them most nights, and then they post in the morning around 8:30 Eastern time. Sometimes I'll do them in the morning, but because I work full time and often I'm in the car at 7:30 in the morning going into the office and meet until 5 almost straight, I do them the night before. But I give you a sense of what I think the market is doing. And this week, I think on Monday or Tuesday, we started talking about AMD as a stock that I thought made sense, and it had a pretty significant move. I hold 2 live meetings a year. One is lower budget, and one is a little bit more money. The low budget meeting will be June 9th through 11th. Actually, on the 8th, there'll be a get-together. I don't get there until, I guess, sometime on the 8th. We typically hold it at a middle tier hotel near the airport in Orange County. I'll be joined by Dave McMullen, who's just an awesome trader, long-term trader investor. He's got some great strategies for portfolio protection, things that came in handy over the last year and a half. Chris White of EdgeRater will be speaking. And I believe they may have 1 or 2 other speakers besides myself. We try to make it a massive value. It's inexpensive, typically between $300 and $500. My guess closer to $3. And if you have interest and want more information, contact me at hgsidoc@gmail, and I can give you the contact info of the person you need to sign up with. Let's take a look at the markets. Now, this was a week where I actually thought of multiple titles. Like, one title was going to be, why is my account down when the indexes are up? Or something about the divergences, which I'll show you. I decided to sit on bad breath because I think that tells the story. The big cap tech, the FANGs, had incredible weeks, some up as much as 12%. But most individual stocks were down. If you look at the NASDAQ, it was up 4.4. You think about the NASDAQ, how heavily the weighting is Apple. Apple had a great week. The Q's 5.8%, so just the 100 largest in the NASDAQ. So right away you could see that the smaller number of stocks, but the larger caps outperformed. The FANGs, this is a leveraged ETF, but it was up 9.3%. Wow, that's pretty impressive. You look at the NYSE, which is broad-based, down 2%. You look at the Dow, down 0.4. The Spider's up 1. I think the more of oil producers and more banks, especially regional banks and index, has the worst it performed. But I'll show you how this market has gotten extremely narrow in what's leading. And I don't think that's a healthy thing. Now, if we've been down, 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 and we just started to turn around off of a major bottom, that might be okay because something's got to start. But I don't think that's where we're at. If you look at the sectors, you could see the leaders were communication, utilities, and tech. Tech and utilities probably are two of the industry groups that really benefit off of things like lower interest rates. Now you'll also notice that why are all these sectors actually green on the week when the markets, and I'm telling you that most market stocks are down, because the components of the S&P sectors are weighted big time towards the larger cap stocks. The larger cap stocks outperformed. Now the other thing is, and if I sound bullish today, you can remind yourself that we're in a new bull market technically on the Qs, which are up over 20% from their October 13th low. And if you look at it in yellow, you could see that the NASDAQ's up 15%, the Spiders are up 12%, the NYC are up 9%, and the Diamonds are up 11.1%. Now, I think those are important numbers because the target that I have if this market rolls over is, do we go back and retest those October 13th lows? Imagine how powerful a signal it would be if we take a 10% dump in the market, 15% dump in the market here, hold those October 13th lows and rally. That's the kind of thing that would suggest that maybe that's the last leg down. So not the worst thing that could happen. If you look at the Q tools, the dark red is Friday, the lighter red is Thursday. And you could see that most of the stocks are in the lower buckets. And we'll come back to that for people who haven't been here before. And I'll talk about that. This here tells me that on the close Friday, 85% of the stocks were trading below the midline of their Bollinger Band. That's a big number. That's up from 78% on Thursday. And when you look at Friday, all the sectors were down. And you can see here, led by financials, down 4.5%. 97% of the industry groups were down, and 94% of the stocks were down. Hard to make money with a broad portfolio long when 94% of the stocks in the indices are down. If you look at it over 5 days, you could see about a quarter of the sectors, industry groups, and stocks were up. And over the month, all sectors are down, 97% of the industry groups, and 11% of the, 89% of the stocks were down. So we are in a rough patch of the market. Now the interesting thing is this is after this big rally off of the December lows, the pullback in January. And so what is this that we're looking at? These are some of the market breadth tools I use. These are from Sager, SuperiorProfit.co. This is his Q breadth tools. And I just wanted to point out this, that if you look at the percentage of the stocks in the whole market, the NYSE, the NASDAQ, you could see we're getting down to low levels of stocks above the moving averages where you expect a reversal. Here's where we were at the end of the year. So I think we can get a little bit lower before we reverse, but we are getting to a place where we're getting oversold by many different parameters. This parameter is stocks trading above the 50 in yellow and above the 200 in white. Down here, this blue line, which has taken a nosedive, tells me that small caps are really underperforming large caps. And this purple line here is telling me growth is outperforming value. So right now, it's large cap growth, FANG stocks. It's interesting. Now, will bank failures force a pivot? I made a comment, I think, on Friday morning that Thursday felt like Goldilocks, that because the banks were blowing up, people thought the Feds are going to pause, and the rates were coming down because the banks were failing. But do we really know what the Fed is going to do? I think the answer is no. I certainly hope they pause, or at least do only 25 basis points and tell us that nothing else is set. But we don't know. But we will find out this week, as I'll show you, because we have a Fed meeting coming up. But notice the rates here are the lowest they've been this year. Here's the 10-year, here's the 30-year, and they both come down considerably. Now, I'm in the camp that we have a recession coming. Here are three pieces of information that suggest it. Number one, this is the 10-3 yield curve inversion. You notice that each time going back to 1988 that we have broken down below the zero line, you see a gray bar that has followed. The gray bar is the recession. The recession occurs after the yield curve goes back to normal, meaning the inversion goes away. What did we see with the bank failures? The 2 years came up more than the 10-year. What would cause the 2-year yields to come down greater than the 10 years? Well, that would be caused by concern that the economy was slowing and the Fed cutting rates, or a insult to the system. Well, bonds went up, yields went down on the 2 years more than the 10 years. Here's the 10-3, here's the 10-2, a similar pattern, and notice both we have this massive inversion. In the lower right-hand corner is more of an economic measure, and this is the Philadelphia Fed Activity Diffusion Index. I think this is derived from the PMI. But what you could see is every time we bottom on this diffusion index, we're in the midst of, or beginning of, or before a recession. Now, we're nowhere close to where we were in 2020, where we were in 2007 and 8, but we're also beyond all the places where we've pulled back and not seen a recession. Here's three reasons why I think we have a recession. Now, this is how tight the money supply is. High yield index option adjusted spread. Now, we are up where we were last year. And so that shows a little bit of tightening. But right now, a spike here to me will be the last straw, because if we see a spike in credit, you know that's going to shut down, and credit tightness, that's going to shut down the economy. If we look at here, stocks above the 200, stocks above the 40, this is something I use routinely. You can see how they've come down. The T2121, the 13-week new high, new lows, is near a reversal area. And that's one piece that would suggest that maybe we have a bounce coming. If I look at these, I think these are fascinating charts. This chart here is RSP versus the spider. So the equal weight spider versus a cap weight spider. Well, what are the leaders in the cap weight spiders? Apple, Microsoft, Google, Amazon. The high growth large caps. What's leading? So what this is showing you here, by this curve breaking down, that the cap weighted spiders, S&P stock index, is way outperforming the equal weighted. Again, the large cap S&P stocks outperforming. Here you're looking at the equal weighted Q, if it's going up, versus the QQQ, the top 100. And when this thing is rolling over so hard, it tells you that the largest cap in the Qs is way outperforming the equal weighted ones. Over here, you're looking at treasuries versus high yield. And this is starting to show you some evidence of some tightening. Here we're looking at XSD versus the SMH, a broader based semiconductor index versus a smaller index of larger cap, and the larger cap semiconductors are pulling this down. Here, the IVD 50 small cap growth versus the FANGs. The FANGs in control. And then if you want to look at the Qs versus the Russell, the large cap tech versus small cap, totally controlled by the Qs. And if you look at these curves, some of these curves are very new changes, showing a change in the nature of this market. The buckets. So let me just talk about what you see over here. If you take the SP 500 and put a Bollinger Band on every stock, you're going to find that some of the stocks are above the midline, 15%, some are below the midline, 85%. That is a bearish posture. Most of the stocks are trading below their Bollinger Bands. If you look at the percent B that the market closed, you can be between 0 and 100, depending upon what decile you are, the best performers at the top, and then some of the stocks can be below the Bollinger Bands and some of them are above. I look at the percentage of stocks that are trading near the bottom of the Bollinger Bands, and when I see we've got 45+% of the stocks that are trading either in the lowest decile or below, that tells me this market is oversold. And you could see a week ago we were at 93% and over 60%. So we've improved from a week ago, but this market is still really oversold. I also know that oversold markets can become more oversold over time. Hindenburg Omen, forget it. We don't look for these right now. We look for these at tops. However, this worksheet can show me the number of new lows, 52-week new lows in the NASDAQ and the NYSE, and they're increasing. 12% on the NASDAQ, 8.8 on the NYSE. So even though the NASDAQ was up on the week, even though the Qs are up, when you look at the general population of NASDAQ stocks, 12% new lows, that's a huge number. These markets underneath the high cap growth at the top are very weak. And then if we look at the broad market, and I'm looking at weekly performance based upon how they closed last week on earnings rank, relative strength, and group rank, and Ian taught us ERG up to about 300. And notice, no matter what the ERG, you were down except for this narrow focus. And you know what lives in here? Microsoft, Apple, Google, stocks that are on the road to recovery. Now you look at, did earnings matter? No. Stocks with the best earnings rank had the worst performance. Did relative strength matter? No. Stocks with the best relative strength had the worst performance. It is bizarre, this market. And then another breadth measurement is advanced decline. And I put this one in here. This is a stock from stock charts. Here's the NYSE. And this might be a very encouraging picture for the bulls. We often talk about needing capitulation before a bear market ends or a massive decline ends. If you look at the three spikes down, here, 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 all of these occurred right about the time the market bottomed. So we could spike down a lot more, but I think we're finally getting some evidence of that capitulation. This is something new that I've been following, and you know, it's interesting because this is a long-term chart. Here's the 200 to 202 bear market. Here is the 27, 28, 29. You could see what happened here. And here is the same signal, the exit signal. The interesting thing is it only fired in the bear markets that had recessions. It's firing here. More reason to be concerned about the market. This is from Dr. Euro Dollar or at Dr.354. He has a YouTube video he puts out most days of the week, and I find it fascinating. It's a simple indicator, and when it's red, it's time to be careful, maybe to get out of the market. Certainly would have helped had you gotten out of the market after the run-up in January. Know your news and earnings. Big week, and the most important thing clearly is the FOMC on Wednesday, the 22nd. We do have jobless claims and PMI and some existing home sales, and we've got James Bullard speaking on Friday. It'll be interesting to see what happens on Friday, because he'll be speaking after Powell has his discussion on Wednesday, and then we got the jobless claims on Thursday. When Powell has been interpreted as being bearish, the talking Fed heads seem to talk up the market. When Powell is perceived as being bullish, the talking heads from the Fed talk down the market. So we'll see. This is a tough week. So this is your news on the earnings. There are lots of earnings. As I say here, it's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. You could see one of the big winners of late, Pindalu, has earnings on Monday before the open. So for the most part, it's too late to do anything about that. Canadian Solar, which is high growth solar stock. Solar has been weak of late. Ollie's, Petco, Chewy, so clearly some retail left. So there's quite a few earnings this week, so we'll have to watch those as well. So I'm not going to read this. Let me just say what I think. I think the bank worries have not gone away. We felt better on Monday because the Fed came out and backstopped depositors. Then Credit Suisse started blowing up. The Wall Street Journal said that another huge number of regional banks are at risk as well. Now the interesting thing is the Fed's going to give them a loan using some of these underwater bonds as collateral and giving them full credit on the bonds. Now think about this. If you have bonds as collateral against money, then you can't sell those bonds because you can't sell the collateral. That means the supply of bonds theoretically goes down and the price of bonds go up and interest rates go down. So maybe that's a little bit of quantitative easing. Clearly, big cap tech, look at that, Google, Nvidia, Microsoft, all up more than 12% in a week. Gold up a lot, but most stocks traded down. Bitcoin up a huge amount. We're at a really interesting place here in the markets. A lot of people say, and I agree, nothing good happens below the 200-day SMA. And as of this moment, only the NASDAQ and Qs are above it. Fed meetings pivotal. Like I said, we probably have an element of QE going on because of the bank liquidity. If the Fed signals a pause or indicates an easing in trajectory or the terminal rate, the markets probably rally big time. So you got to be careful shorting going into Wednesday. However, if the Fed says they're staying the course, and if they emphasize their concerns about inflation, despite the banking crisis and recession risk, we're going to go down. And I think a retest of the October lows, which is bearish as can be, is not out of the question. So what am I doing with my money? Cash is still king. Plenty of time to build the portfolio when we get all clear. If you've been watching my morning videos, I've been playing triple Qs, SOX L, and AMD. But boy, tight leash. I took some off at the end of the week as they softened up on Friday as well. Again, I'll put the link for this. The Wealth 365 event is just an awesome event, and I'm just going to revisit something I look at to remind me. In black are the Fed rates. In the blue lines are the market bottoms. How many market bottoms going back to 1973 do you see in the setting of rising rates? They don't happen. Historically, the Fed cuts before the markets bottom. The Fed is still raising. Why would we think we're at a bottom already? The other thing here is just this black and this red box. This is the difference between a bear market occurring in a secular strong economy versus a secular weak or recession. If we go into a recession, this bear market can get much worse. All right, on to the charts. And that was about 24 minutes, which is longer than I normally spend. but I do think this really is all about the market. First thing, when I look at the top-down indexes, I look at the wealth scanner and I'm looking for hot stocks here. There are none. Or hot industry groups. There's just nothing moving up fast. Gold moved up fast last week and it's still doing fine. But there's nothing coming off the bottom showing a lot of strength. Let's take a look at the indexes. Let's start with a 5-minute of the spider and let's blow this up. So let's look at what happened this week. Okay. That's the 15th. It's not going to go far enough. All right. Okay, here's the 16th. And the 16th is really when the market started to have some ugliness. So the 16th was Thursday. So we could see here on the 15th, closed down. The 16th, we rallied. All right, great day. The 16th felt like we're back in January, a bull market, massive move up. And then the 17th happened. And the 17th, we gapped down and traded lower on the rest of the day. And that's how we ended the market. So we've had an interesting week with a lot of ups and downs. And a lot of it was news driven. I think this is when we found out about Credit Suisse before the market opened up. This was Tuesday, gapping down because of banking concerns. This is Monday, gapping up because of the banking rescue. So this was a very interesting week of movement. Not exactly a trending week unless you're a very short-term trader. Spider, daily, closing below the 200, below the 50, above this trend line here. That trend line is important, but the fact we're below the 50 and the 200 is worrisome to begin with. The Qs, the strongest of the bunch. You got the 50 crossing over the 200, which is bullish. You still got a new green daily and a green weekly bongo. This is the strongest index. It's above its major moving averages. The diamonds, they broke below my box. They broke below the 200. They have failed multiple times to get here. Typically, when you fail at the moving average that many, you're coming down to retest some prior lows. Does that get us down into the 307 range? Perhaps. Maybe it starts to look at this is where the October lows. So when I talk about the October lows, it's the yellow line here. It's a far distance. It is I believe it's the white line here. I hope we don't go down the October lows. Look at the Russell. Nothing's good here. Russell's back down to the December lows here. The yellow and white are the highs before the bear market in 2020, and it's the October lows. They're kind of superimposable. Like the Dow, like the spiders, the Russell has broken way below the 200 and the 50. There is nothing bullish here except for the Qs, and the Qs are still off of their highs. If we look at the UVXY, interesting, the VIX had a big move and then just went sideways. On the week, just looking at, let's make the UVXY, let's look at that one instead here. On the week, the UVXY was up 7.82%. Hasn't gotten crazy, but sometimes it's hard to interpret these things because of so many, what's the word I want to use? So many reverse splits. You can see here that the VIX daily had a 29% move on the 10th, and it's had some pretty big swings within the day. But it's still closed down here at 22, so it's up on the week, but it really closed at the bottom of the last several trading days. The dollar, something that a strong dollar is not going to be good if you're looking for a rally, is still above my line in the sand, but it's come off its recent run up to the 200. If we go look at commodities, Dollar has been weak, so gold and silver are strong. Gold is one of the strongest things in the market right now. Since I don't trade a lot of Bitcoin, it's probably the strongest thing that I look at. Is this fear? Is this weak dollar? It's certainly a place to be for safety. Oil has sold off. You can see a gap down here on the 15th, which was Wednesday, traded lower again on Friday. And I think this is a signal that a lot of the market participants think we're going into a recession. And, natural gas gave us a tease, but natural gas is doing nothing. The 10-year, I thought I hooked up. It may be that the Tastyworks feed may be sleeping. Sometimes it does that over the weekend when they're doing work. Yeah, I'm not getting the TNX. We already showed you before the 10-year has come down. My weekly timing model, you notice I'm going to put direction here. They will stay that direction until the close on Friday. And you could see spiders, Russell, diamonds are in sell. And then we are positive on the Qs where we're above the 30-week moving average and have a green bongo. But that's it. And we know that's narrow because the QQQE is really lagging the Qs. Sectors hourly. You could see materials weak, communications, Facebook doing great, energy doing weak, financials weak, industrials weak. What's been leading is tech, and it's still leading. Tech and communications. Now, with the weakness of the market, defense staples, utilities, and healthcare have improved. Real estate, I think commercial real estate is just killing real estate here, are down. And then interestingly, discretionary is holding up probably because of technology. We already looked at my breadth indices. I think these are important enough that I'm actually going to look at those on a weekly basis, and I built a workspace for that. Am I bullish or bearish? I'm certainly not bullish. I just think it's hard to be too bearish coming into that Fed meeting. So let's just start by looking at the markets. So heat map, this is great. What did I say worked on the week? Big cap tech, Microsoft, Google, AMD. Those were the leaders. You got Adobe in here and Cisco. But this was driven by big cap tech. If we look at Wealth Scanner, you're going to see gold and technology, and probably some bonds. Now notice we're back up in the 700s on gold. I mean, have I shown you a better chart than GLD? No. GLD has just broken out to a new high, recent high. Here you got to go all the way back to here, which was April 2022, a year, to get close to this point. I think gold can go much higher here. Look at the relative strength compared to its moving average, the volume. XLK as technology, we're only in the 600s, but you could see technologies trying to break out. And even though Friday was a rough day in the market, this was down just 0.14%. The triple Qs are going to be 3 times the fun of the Qs, has broken above its 200, down 1.48% on Friday. And here's the Qs, which also look very strong, and they were down, should be a third of the Qs at 0.47. Then you got the FANGs and semis and communications. Is there really anything else to be looking at besides energy and semis and maybe FANGs? I don't think so. So I could go into my CAT scanner and I could pull up whatever we want. So let's start with semiconductors. Now, these things have run, so we may or may not see things that are at potential buy points. The only thing that has any active dots is NVIDIA, and you could see this is just gorgeous. But is it too far to buy? It might be. You had a big 4-dot play over here coming out of the short-term red bongo. But NVIDIA, it looks great, but we can look at all of them. Meta. And now you start having to look at the high jump. So even though Meta looks like it's had a big run, it's not extended. Didn't have a great day on Friday, but it set a recent high on Thursday. So Meta looks interesting. Amazon has been a laggard in big cap tech. Let's see what it looks like. Still a laggard. All right. How about Google? We'll just look at this one of the alphabets. I'll always call it Google. You know, Google's had a very big move over the last 5 days or so, right up into resistance. How about Apple? Up around recent highs. It was down all of 0.5% on Friday in a weak market. It's had good volume. Apple looks good. And then Microsoft. Remember 12% move on Nvidia, Microsoft, and I believe Apple last week. But let's look at Microsoft. Wow. True leader, Microsoft. These are the same things that led off of the March 2020 bottom. Interesting. Okay. Um, let's look at gold miners. Remember, I'm not looking for things that are extended with the scan. I'm looking for stocks that have had a recent reversal within the last 2 weeks on the short term. AGI, Alamos Gold. You don't want to buy the gold ETF? This looks exactly like it. Look at the massive volume into this small cap growth stock. Relative strength OBV. That looks beautiful. AUY. Breaking out. Looks beautiful. BVN is, this one's a South American. A little bit less easy for me to figure this chart out. But you could see plenty of things to like. Franco Nevada. More of a large cap play. Breaking out there as well. What about silver? Pan American Silver. Lagging gold, but also breaking out above resistance here on massive volume. So clearly, if you have to buy stuff, you might want to be looking at gold. You might want to be looking at some of the semis. I mentioned, let's just go look at, let's look at AMD. You'll find these on my early videos in the morning. AMD, this is the day I think that we called it out. Let's see, is that the day that had? This is the day. And so this day it was in the 87. It went up $10 over the next 3 days. AMD continues to look very strong. Now, there's a bunch of stocks, gold, silver, some of the semis. We've got to be careful with this market. Now, do you just go jump in and buy contra ETFs? That would certainly be a question. And if you come down here, I can look at my contra ETF. And as I told you, my concern about these is the Fed's coming. Dog goes up when the diamonds go down. Dog looks great. It's above the 200. It's gone sideways for the last several days. Is that a bit of a bullish wedge? Does it go higher? I bet it does, but am I ready to commit to that just yet? I don't think so. ARKK, if small cap growth like the 50 are not doing well, you'd expect ARKK to do poorly. This hasn't given me a signal. SARK is short the ARKK. SDS goes up when the S&P goes down. Again, I'd wait for it perhaps to break above the 200. SOXS is going to look horrible because technology is leading the market. It does look horrible. TZA goes up when small caps go down, and this is probably the best of the contras right now because IWM is the worst of the major indices. And then the VXX goes up in volatility, and you could see what VXX did this week, where it had a massive 300% move, which is hard to believe, but this is a leveraged ETF on that was on the 7th. This is the 10th, 13th right here. So a big move here. Just looks a little bit funny to me, this gap. I don't think there was a reverse split occurring now. I think this really was a massive move with the recent market sell-off. It just looks a little weird in this chart. But we'll have to see. So just to summarize, and again, if the market's bullish, I'll spend a lot more time on stocks. It's just the last thing I want to do here is paint a picture that you need to be going all in the market. So my summary is the markets are at a critical pivotal position. The Fed will make a call on Wednesday. If it's perceived as being a dovish Fed, then considering that we are oversold, that we have those buckets, we have stocks below the 50 and 200, are all at reversal areas, a dovish Fed probably triggers a pretty impressive rally. A hawkish Fed, I think, takes us down significantly. So how do you play that binary event? To me, I raise cash, I'm nimble, I'll take the market I get, and I'm not going to predict in advance. Will I put some light positions out? Sure. Controlled, limited risk, like my TQQQ, SOXL, and my AMD. But I think this is a place to be careful, not to be a hero. And we'll see what I say on Thursday morning after the Wednesday 8:30, or should be Wednesday 2:30 and 2 o'clock announcement and conference. Have a great week. Thanks. And oh, by the way, just to remind you, um, if you can do me a favor, and I'd really appreciate it if you click on the link in the on the YouTube site and just register for Wealth 365 using my ID. Have a great one.